Thank you for joining today's webinar, How to Get Funded with Dr. Jessica Stauth. As I said before, today's speaker is Dr. Jess Stauth. Jess is the Managing Director of Portfolio Management and Research at Quantopian. Jess and her team are in charge of selecting the algorithms from the Quantopian community for the Quantopian portfolio. Quantopian offers licensed agreements for algorithms that fit our investment strategy, and the licensing authors are paid based on their strategy's individual performance. Previously, Jess has worked as an equity quant analyst at the Starmine Corporation and as a director of quant product strategy for Thomson Reuters prior to joining Quantopian in August of 2013. She holds a PhD from UC Berkeley in biophysics. Thanks, Jess.
Okay, thank you, Paige. Okay, so I think that this is the third webinar that I'm doing in this series, which maybe means it will be quarterly. We'll see. Maybe we can do them more frequently. Those are both true. Oh, everyone can hear and see. I see a lot of familiar names in the list. Excited you guys can all join. We started, I think in like June or July, maybe July or August, we did the first Tearsheet review. I was looking back at sort of the evolution of what some of the feedback has been and just continue to be incredibly impressed that folks are really sort of listening to the guidance and the ideas that we're sharing here. And really every time we ask for submissions, the quality just keeps going up. I think you guys could all see that in the comments that were happening in the thread. Folks were sort of realizing, wow, these are actually really like looking pretty good, which is my high level feedback. These strategies, all looked pretty good. Now we'll see if I can advance the slides. So what I did this time, we got 22 strategies submitted. A couple may have been one strategy across 2 time periods, but give or take, I was able to find 22 strategies across the 2 threads that we had. And so that's a lot of strategies to sort of go through and talk about individually. I will probably touch on a couple of observations that I had, but also it was so many that what I thought would be useful is to basically try to aggregate up and look broadly across what was submitted and sort of talk about some themes that I saw. So these plots are a little bit small, so I'm just going to jump to this actual spreadsheet where I basically what I did was I just looked for each strategy and I grabbed and put side by side all of the summary stats. And so actually it was kind of interesting to see you guys pick what time range you want to run your back test over. I will show you, I also did loop in or rope in, I guess, one of the folks on our research team, Renee, who was kind enough to take all of the backtest ideas from this cohort, and we also ran our own separate backtest over apples to apples date range, so same date range. But here you can kind of see people all ran over a 2-year plus date range, so these stats already are probably sort of comparable. And then it's a lot of strategies to look across. So I thought what was kind of interesting was to just sort of pick out some things and look across the population of 22 algos. So the first thing really on kind of quality, and again, we all know that we're looking at backtests. So you guys are clearly, intelligently selecting good looking backtests and submitting them. So with this kind of feedback, it's tough for me to necessarily give a lot of guidance on whether I can tell from this that you're submitting. Some people give me in and out of samples, some people don't. So I'm not really kind of speaking to overfitting. So let's just sort of evaluate the backtests as they are. These strategies all had a specific Sharpe ratio of about 0.5 or higher, all of which would, in our mind, I think, be considered good, good enough for us to look more closely at them. So that's cool. Then I looked at just a couple of other metrics. So daily value at risk, daily turnover, max drawdown. And when you scan through these, you can definitely see that there's one strategy that sort of stands out. Now, I think this is real that it has 500% turnover, but that's the strategy that's standing out that's just turning over a ton and has high VAR and has a high max drawdown. So if I go up and say, okay, which strategy was this? It was Warren's strategy. And actually, this strategy is interesting because it is a short only strategy. So the strategy is holding, and I apologize, I don't have the tear sheet up, so I don't remember off the top of my head if it's the same 15 shorts or a rotating cast of 15 shorts, but basically there's 15 positions that are all short at any given time. So I thought this was kind of interesting. It's a strategy that if our turnover metric here is sort of saying the right thing and it's turning over a lot intraday, it would fall into the category where it's not very well modeled by our risk model, because our risk model is really a daily risk model. So from there, I'd sort of say, well, okay, it's a little bit tricky for me to evaluate, what its alpha is, what its beta really is, because I don't think our risk model does a great job at that. Nonetheless, it clearly generates a lot of returns. And so one thing I thought would be interesting to highlight to give you guys as sort of updated guidance is we're definitely trying to expand the way that we're thinking about how to get value out of strategies. And so definitely if you had asked me like a year ago, hey, do we think we could get value out of this strategy? I'd say, well, it's really far outside of the sort of design. Now, today, what I would say is, hey, it, appears to have positive returns, positive specific Sharpe. If I could understand the economic rationale and figure out and really believe there's an interesting, unique idea here that's robust, actually, we would try to think about a way to put this into our portfolio. And so actually the feedback on this one would still just be around that small number of individual positions. So that's still going to mean that however much capital sort of exposure we would allocate to this strategy, it has to be divided up equally or in some other weighting scheme amongst a very small number of names, of positions. And so would basically place a low limit on how much capacity, how much capital we could allocate to this strategy. So let's say that there's a really interesting idea here that's short focused. That tends to be pretty challenging to find. So that's very cool. And it would be great to try to apply that core idea to a broader swath of assets, basically. And you can kind of see, if I go back to over here, average portfolio size. So these in sort of non-quant fashion, I literally just like eyeballed the plots. So in some cases, you can see that folks are very specifically picking how many positions, and they keep their portfolio size almost exactly that number of positions on any given day. And then there are some cases where I saw tear sheets where, the number of positions sort of drifts over time in a way that doesn't necessarily look like it's all that guided. Now that might be because you were picking some universe size and deciling or quintiling it, and then that universe size was drifting over time. But anyway, I eyeballed and picked sort of roughly what was looked by eye, sort of the average size of the portfolio, which is the average number of longs plus the average number of shorts. And I think when we talked in the summer webinar, I sort of drew this arbitrary line and said, hey, an algorithm which has fewer than 100 positions at any given time, I'm going to call that concentrated, and say like what we'd love to see are algorithms that are making decisions and placing bets on more than 100 positions. So if you sort of use that yardstick and look at this set of algos, there is a lot of work done on trading much larger universes. You can see we have one strategy that's all the way up towards getting close to trading about, that's probably about the size of the Quantopian tradable universe, give or take. I would say top 2,000 most liquid equities in the US market is sort of where we want to be for our investable universe. So it's really awesome for us to have access to a strategy that holds all of those positions, because it means that you're sort of providing us a signal or a view on every stock in our investable universe, and we would view that as valuable. Having that breadth is very valuable. And again, it doesn't mean that we wouldn't be willing to look at some of these algorithms that have smaller portfolios. The trade-off really is just going to be one of the broader the signal, the more capital or the more weight we would be able to put on it if it gets selected. Okay, I'm going to just pause for a second to see if there are questions on the. Yeah, I'm happy. I didn't ask anyone if I can share these slides. I don't see why not. So unless someone tells me between now. And then are cryptocurrencies included in the list of available assets in Quantopian? No, probably is the answer. I'm not sure if you're asking in terms of what we provide data to run back testing on, or in terms of what we can invest in our vehicle. Neither of those do we currently have cryptocurrencies. Okay, good. So I think I answered questions for now. Let me think if there was anything else I wanted to really point out. Yeah, I'll share this so then you guys can have this like nice summary of everyone's strategies. What you can basically what you could see is if I just gave you this big table of numbers, you'd say like many of these strategies look good, right? So there's good Sharpe, good specific Sharpe, and none of the sort of gotchas that I tend to look for of, crazy turnover or super high vol, super high drawdowns, right? There's just not a lot of red flags. Again, there's sort of one or two strategies. Oh, I remember there was one other thing I want to point out. So it's the same strategy, Warren's strategy, where he's shorting 15 positions. There's one other thing about it, which isn't a deal breaker, but makes it more challenging to compare. So this one is at an average leverage of about 0.2. So it just makes it easier for us to analyze when strategies sort of have some amount of capital and deploy all of that capital and manage that leverage close to 1. But that's not necessarily a critique. It's more just it makes it a little bit easier for us. We can kind of go back and try to back that out. And then I guess the question would just be like, why not deploy all of the capital? And I don't think, as I'm remembering looking at that tear sheet, that it was sort of obvious to me from the tear sheet that was done in a particular timing way, although that might be the case. So that would be a follow-up question I would have if I were to have the time to sort of sit and go through that strategy in detail. Okay, you can see my slides still, right, guys? Mm-hmm. All right, so this is another, this is sort of that meta-analysis that I was talking about. So we have been doing a lot of work internally here, as you might imagine, trying to continue to evolve the way that we analyze all the algorithms that you guys are putting into our database, submitting to our contest. And one of the things that we have been working on is sort of thinking about how we can go through our algo database and sort of classify algorithms, right? So there's, the basic subdivision of, do we think this thing is good or not? We focused a lot of our time on that in the first year and a half. That's a very hard question to answer, but we believe we have made some progress on that front. Kind of like surprising to say that. That's fantastic. And so as we made progress on that front, we're having to face that next problem that we've definitely talked about a lot and we often get questions about, which is, well, great, okay, so now you've got a portfolio of algorithms that you like and you've deployed capital to them, and now you want to continue to expand the size of that portfolio of algorithms because you'd like to keep adding more and more alpha, right, into your portfolio. So now that you have an existing portfolio of algorithms you want to add, you have to think about, I'd like to add differentiated, uncorrelated alpha. That's, we have talked about that for years. So one of the things we thought about there was to say, hey, can we start to classify algorithms beyond just sort of some arbitrary cutoff threshold of quality, right? So here's an example where I said, let's use some threshold to cut off strategies, below some specific Sharpe ratio threshold. And the number in the circle, the 36%, is the fraction of a much larger sample of algos in our database that we had run this classification analysis on. So I looked at this analysis that Renee on the research team ran and was like, oh, this is really cool. Hey, I have this new cohort of 22 algorithms that were submitted for the contest. Could you take all the backtest IDs that you guys submitted, could you run fresh simulations on them? So she ran a backtest, all in the same initial conditions from, I think, January of 2015 to January of 2019. So take that now sort of new apples to apples set of backtests, and can you run it through this same classification? So like I showed at the beginning, all of the algos, I think there might have been one that dropped out that she couldn't get a tear sheet on, but basically all of the algos passed that Sharpe ratio threshold. So right away you can see, I guess I could have showed this as a percentage, but 100% of these strategies pass. Well, okay, so you guys did a great job self-selecting and submitted strategies that, had a good specific Sharpe ratio. And you can see that of the sample that we are looking at here, I don't remember the exact numbers, but it's something around 25,000 algos. We're saying about 36% of those were passing this particular threshold. The next thing that we look at, because we are really trying to make sure that we're casting as broad a net as possible. So when we analyze the data exhaust of algos, we don't necessarily want to throw algos away who are trading some assets that are outside of our target universe. So we brought online a couple of different template universes for you guys to use, and I think the sort of most representative one of what we trade in our portfolio today is the Quantopian tradable universe, aptly named. But over time, we've brought those tools online, and we don't want to necessarily like be constrained to not look, 3 or 4 or 5 at this point years back in our database and look for algorithms that were written before those universes were available. So what we did, which is something I've been wanting us to do for a while, but we did basically get working, is to go back and say, hey, let's just basically drop out of your strategy positions that aren't in our tradable universe and recompute the statistics on that. So when we do that and we say, okay, well, what strategies have a specific Sharpe exceeding our threshold only on the assets that we would trade, we actually lose a bunch more strategies. So not of these in the thread, you guys are all submitting to us strategies that are in the trading the Quantopian tradable universe. So all these 21 algos pass through to the next sort of set part of the classification. But you can see that in our data set, well, yeah, we are losing a bunch more. And that I think is reflective largely of the fact that prior to having those universes available, you would have had to sort of, if not get lucky, you didn't really have that tool to check. And so we're losing, I think, more older algorithms for that filter. So then the next step is just sort of the first, once you sort of say, I think this algorithm is good, the next kind of most interesting bifurcation is, well, okay, is it good, but it's basically has mostly common risk exposures to common risk factors. And here, I believe we're using the Quantopian risk model. So Renee, who ran this analysis, was also the architect and main author of that risk model. And so in our data set, sort of the underlying big 25K data set, we see about half of the algos that are good, sort of half of the 16%, are common risk dominant or mostly have exposures to common risk factors, but there's about 9% of the whole data set that have returns that are generated not due to common risk factors. So that's the set that we're the most interested in. And very cool, almost all 20 of the 21 strategies that we evaluated this way that you guys submitted were specific risk dominant, or basically you guys are either using the optimizer or you're designing your strategy in such a way that you're capturing returns that are not dominated by common risk exposures, which is fantastic. That's very cool. And then we have sort of one more layer of classification that we have been playing around with looking at. And this is when we start to get into thinking, okay, we have some idea about where we have coverage in our portfolio today for what types of strategies we have invested in. And we want to try to look at sort of where we could go look if I said, well, gosh, we don't have very, let's say that we decided we need more sentiment strategies or we need more pairs strategies or what have you. How does that breakdown look? And so that breakdown, you can see we've got, I think I spent a lot of the last 2 webinars, I think I was talking, especially maybe last time, about the need to use more of the fundamental data in strategies to move away from sort of pure price-driven strategies. And we've definitely seen people taking us up on that and really following that. So what we saw that I thought was interesting was there were a lot of strategies that you guys submitted to us that were sentiment-driven strategies. But then excitingly, there were 8 strategies that didn't fall into one of these buckets cleanly. And that's actually a good thing in our eyes, because what we're looking for and what we're very excited to get from you all is just a very diverse set of ideas, is the way that I've sort of come to think about the output of these algorithms. You guys have ideas, you write them down effectively in code, we interpret those results from simulation, and then we try to basically classify your ideas and prove out to ourselves that we think that they're compelling and then invest in them. So this I thought was pretty cool. I'm going to just pause and see if there are more questions. I can read, this is fine, I can read them here. So the specific Sharpe ratio is just the Sharpe ratio computed on the returns once you have regressed out the common risk exposures. So it's computed the exact same way, you're just using the idiosyncratic returns time series, and you can see that in the tear sheet that's generated. I don't know if I pulled out an example, but I can do that now if I can open one of these. So at the very bottom of your tear sheet, when you run it, there's this sort of risk summary report. And here you're going to get broken out your annualized specific return, annualized common return. So the common return is the returns portion that's attributable to all of these factors that are included in the risk model. So there are 11 sectors, and then we include 5 styles: momentum, size, value, short-term reversal, and volatility. So if you used a different risk model, more factors, or a statistical risk model, you would come out with a different breakdown here. But basically, this is showing you your annualized specific return, and this Sharpe ratio is computed on that daily time series of the specific returns. And really why we care about that is it's a nice way to sort of skip over and sort of cut right to, what are the returns generated by this strategy that are not due to common factors. And we have spent a lot of time talking about this, but I'll sort of reiterate it. Why are we sort of like not interested in common risk exposures? It's really sort of less about that we necessarily would have some view that in any given month or quarter or year that those will generate returns or not, but it's rather that those common risk exposures are very well understood, and at this point they're fairly easy to get and cheap for investors to get. So if I want exposure to size or value, I can go and buy an ETF or a mutual fund or something that has that exposure, and I can pay a very low fee ratio. Whereas if I want to be able to market a differentiated fund product where that's going to have higher fees, then you want to be able to say, hey, what's in this product are ideas that you cannot get elsewhere. They're really unique. Okay, I'm going to go through a couple more questions. So right now we're only analyzing the strategies that are trading equities, and that's just because we're currently only trading equities in the vehicle. So we have not been working on the future strategies, but I'm hoping to get back to them. One challenge I have is how to meet the minimum turnover of 5%. Oh, because that's probably a contest constraint is 5%. Okay, I'm just going to take that one away because there was like a lot of pain and gnashing of teeth thinking about like what those turnover bounds should be, because in some sense, the lower turnover bound, like in my way of thinking, you'd be like, well, it can be slow, right? That's fine. And some strategies, the average turnover, the way we compute it, can be like not like sort of, misleading in the sense that maybe a strategy will rebalance like once a month and have 100% turnover. And does that mean the same thing as a strategy that's turning over, 5% a day? And yes and no, right? It kind of depends. So I'm not that concerned with strategies that have too low of turnover. In general, I think we tend to see on the platform folks chasing much too high of unrealistic turnover. What I don't want, and what we were trying to guard against in the contest, is basically just picking a single portfolio and staying in that exact portfolio, which then, right, can sort of just work by chance. And so the idea of saying, well, you want to have an actively managed strategy that's continuing to make new bets, so that you can accumulate confidence in it. That's really why that threshold was there. But whether, 5% is right or we could lower it. Certainly I'd say, like, if you have a strategy that's lower turnover than that and you want us to look at it, you should definitely send it our way. And I will think about whether we could do something to widen it in the contest. How can a short-only strategy stay dollar neutral, which is one of the risk factors? Well, the risk factor is actually beta, correlation to the market. So I do think it's interesting. Well, actually, so that short-only strategy, remember I said that our risk model is really a daily risk model. And so I'd have to go back and look closely if that strategy is holding all those positions short at the end of the day, but I'm not confident that our risk model can do a good job evaluating that strategy. But definitely if you're short only, you're not dollar neutral. Depending on, what you're shorting, you could have low beta. You could just be short a bunch of low beta stocks. So you might be able to get by that. I don't think that short only strategy would pass the contest criteria and would be in the contest, but someone just submitted it here. Another question about futures. I always, like, every time I address this, I'm like, I hope to get to it soon. So I'm just going to say the same thing. If you've written futures strategies, I would hope that we can get there. It's really just been a process of wanting to make sure that we're really happy with the equities investment vehicle before we expand, but still directionally would like to do it. Yes, another question on futures. All right, well, I'm going to note down, or you guys can help me write down. Lots of people are excited about futures. I would not introduce noise to make your strategy meet the minimum turnover. I'd hate to see you like feeling like you're having to make the strategy less good to get it into the contest. So I think it would just say, like, send it over. We can look at it and specifically talk about it. In general, just if you took a step back and said, like, oh, I actually have a strategy that is not high enough turnover. One way that people do try to increase the turnover while adding alpha is to say, like, do I have some weight on a shorter term signal? So if your strategy is mostly driven by quarterly updating fundamentals, well, yeah, like, there are not inputs to your model that are going to cause it to be changing its rankings and changing its portfolio. If you put something in there that looks at a shorter term signal, whether, for now that's price or volume or sentiment, you should be able to introduce perhaps some shorter term alpha. So that is what you would do if that was your goal, was to bring the turnover up a little bit. You'd like to do it in a way that is not noise, but that is, injecting some alpha. So specific risk dominant and common risk dominant, I don't know the exact threshold that Renee used, but basically what she is trying to do is say, are the majority of the returns generated by common risk factors or specific? So I'm assuming she drew some line and sort of sorted them into two buckets like that, but that's the intent to get. And I will, what I can sort of promise to do is to beef up the slides with a little bit better descriptions of exactly how those classification buckets were defined. So there's another question on, like, what does pure sentiment mean? I want to double check. So one thing that, we can look at is what data sets are being imported. So I want to double check whether that category means, we know that sentiment data is being used, or if there's some other more nuanced definition that Renee was using. There's a question about, is there sort of a minimum Sharpe ratio? I hate to sort of use really specific hard cutoffs, because if you think about, like, a Sharpe ratio, that's sort of a quantity that you're measuring on a particular backtest over a particular time range. And so, like, yeah, look, a Sharpe ratio of 0 is probably going to be too low. But what does it mean if I have a really consistent Sharpe ratio of 0.5 and I really believe it, and it's, out of sample or it's on live data? maybe that doesn't look so bad, like a realized Sharpe of 0.5 on a component of a strategy or a component that's going into our broader model. Could that be interesting? Sure. Is a Sharpe, it's much easier to sort of speak in broad relative terms and say, well, gosh, sure, but a Sharpe of 2 in a back test, if I don't think it's overfit, would be better. But I'd say, if you're looking to try to find things that are consistent, so higher Sharpe ratio is better. But if it's, consistent year over year over year and it's positive, that's potentially of interest to us. I think there are at least 2 sentiment data sets, Sentex, and isn't there one other sentiment data set we have on there? These guys have no idea. I'll look it up. I think there are 2 different sentiment data sets that are on the platform. I'll double check. When performance metrics are similar, except when the algo is trading weekly versus daily, weekly peak turnover may be 3 times of daily peak turnover. How to trade off trading costs versus peak turnover. I don't know exactly what you mean, but I think this question is getting at the thing I was talking about of turnover is so, sort of like one of these deceptively simple numbers of, well, how do you want to measure turnover? I know we internally have switched 3 different times the way that we think about measuring turnover. So is it dollars of turnover? Is it, number of trades that you have to make, and is it on a rebalance day or not? I think the best way to think about it that I have heard from practitioners is really taking a step back and saying, okay, if I have a portfolio, so we're giving you this percent number here, right? And I'm saying that's your guidance. But if you wanted to sort of get a sense of whether it's rational or not, I think it's helpful to think about, if I have a portfolio I'm going to invest of $1 million or $100,000 or whatever it is, $100, how many times am I going to be trading that money over that year, right? Is it going to be 1 time? Is it going to be 12 times? Is it going to be 1,000 times? And I find that sort of number gives a little bit more of a grounding to where you're saying, well, okay, if I'm going to be trading, this money 1,000 times over, right? Forget however perfect I can estimate my T costs or not. We know they're not 0. So if I'm trading like crazy, turning my book over 5 times a day or whatever, wow, I need each trade to be very profitable because I am going to be doing this a lot. And so not only am I going to be incurring some cost, I'm also going to be incurring market impact, which you can sort of roll into a cost. So I think that if you came to us and said, well, gosh, look, annually my turnover is like this. I currently rebalance it at this frequency. Do you guys have input on how to change that? We would be happy to give you some ideas around that. Usually what people try to do is think about the alpha forecast horizon for their strategy. So back to sort of thinking about what your input data sets are and how frequently those are updated. So if I was trading a strategy that was purely driven by quarterly fundamentals and that's it, then maybe I have no reason to trade, except around earnings or except at the end of a quarter. Whereas if I have a strategy that's consuming a bunch of different data sets and some of those are daily, then in that sense, you want to say, well, okay, some of my signals actually might have short-term alpha over a couple of days. So if I'm not trading my portfolio every day, then I'm missing out on value that those are going to give me. So I would tend to think about it like your preference is to trade less and trade slower unless you can justify it. So look at what your fastest updating data set is and then see what you think is reasonable, basically. Oh yeah, nice. Psych signal, the stock twit psych signal data. We crowdsourced that answer, guys, so you can feel good about that. So those are the 2 data sets that are available. And I think a lot of people are using that psych signal data set. I think I'm seeing a lot of it. What is the protocol to introduce your own sentiment data set? So, and then if I introduce one, can it remain for my use only or does it become public? There is a feature called self-serve and that's public and people can use it right now, which basically, if you get your data set into the format that we accept, which is something along the lines of date, ticker, it has to be the ticker on the date if you're uploading historical data, right? So ticker, date, value A, value B, value C, something along those lines. You can upload that to your own account, and it is private to you. It will not be shared with anyone else. And I believe that we have set it up such that you upload a historical copy of that data, and then also we'll check that source, that like it has to be at a public URL, I think. And then we'll run it and update it daily, which is kind of cool. And then we like save that copy for you. So it's actually quite a cool feature. We have thought about and talked about whether we could use and expand that tool to allow sort of like more collaboration and sharing of data sets and broadcasting. And I have a couple of ideas around that, but that's very forward-looking right now, or more forward-looking right now. Do we have a model when we implement these strategies that bounds the risks on short buying? Brokers usually want 25% margin account. What do we estimate we need to control the risk of shorting? We have a lot of, I won't even try to get into the complexities of like how our account works. I will say that we have an institutional account, and so we're running a dollar neutral hedged portfolio. And so if just sort of I'm trying to think of the right compliant way to say this, but basically like from a broker's perspective, the portfolio that we are trading is extremely low risk. And so yes, we are shorting, but we're not taking concentrated short positions, and we're hedged on the long side, and we're hedged to like every risk factor. So overall, we're running like what would, from a counterparty's perspective, be a very low risk portfolio, which doesn't guarantee that it's going to make money every month, but it's low risk with respect to the way the counterparties think about it. Could you speak to some of the benefits of getting an algo funded? Sure. And I know we have a lot of folks on the webinar who know like this whole spiel, so I will kind of give a brief overview of it. But basically the way it works is if you have a strategy on the platform that we discover, so I would say our highest hit rate recently has been from the contest. It's just provided like a pretty nice set of guideposts. So let's say your algorithm wins the contest, and also like those of you, there are some people on this call who have worked with us, we work very methodically. So you may not hear from us for a while, then you'll hear from us, and we sort of tend to have moved in batches of strategies that we've licensed. So we licensed a big batch of strategies in the fall, and we talked about that. And we're working hard on another cohort of strategies right now. So hopefully we'll be able to have sort of another class of strategies we put in. So how it works is basically we reach out to you. We have a separate portal on the site. We message you, and you get to basically take a look at the algo that we're interested in and say like, yes, okay, I am interested. You have sort of a couple different places along the way in which you can opt in. And then we share with you a copy of the license agreement. You read that over. It doesn't guarantee sort of how like exactly what your allocation will be, but it lays out the terms of how you'll be compensated and the term of your agreement. And it's pretty straightforward. Like it's not a very long agreement. So folks will read that, and I would say more often than not, they're like, sure, yes, I would like to see if you would like to license this strategy. And really, like, I guess the benefits are, you've already built it. You have no marginal work that you need to do at that point. And then if we're able to generate some profit using your strategy, we share it with you. So what you do is get a monthly statement from us that sort of line items out each strategy we've licensed and how it's performed and what your accrued royalty payment is. And right now, the way it works is that our fund investors crystallize performance payments to us annually, and that is typical. And so right now, especially while we're sort of getting started, we have that frequency matched for our author payments. So authors, I think we're actually just getting ready to send out the 2018 royalty checks to the authors in the fund right now, which is exciting time for us. So you get paid annually. In the long run, I think it would be really nice at a larger steady state if we could have a more frequent cash flow, but that's how it works right now. And so yeah, like those are the benefits. And we have had a lot of positive feedback from folks who have worked with us, sort of whether or not they've made it all the way through the process. That I think another benefit is just like, we will work with you. We're happy to talk with you in detail about your strategy. You guys are thinking hard about the exact problems that we're thinking hard about all the time internally here. So I've had good feedback also from folks that they just enjoyed interacting with people on the research and investment team and talking about their strategy. Okay, so I've made it through all the questions. I will go back and show you guys just a couple, see if there's sort of a couple of other interesting. So what I did with the slides, I always think it's interesting to sort of skim through, and I should either just fix this myself or file a issue somewhere that I'm sure you guys know this as well. The factors are not always the same colors. That would be like awesome if it was like always momentum was red, but it's random, randomly assigned. So what I think is kind of interesting is to just look at the sector and style exposures, like from a sort of very broad brush. And when you do that and you line them all up, you can sort of skim through all the algos and see, okay, sure. So, who's managing these exposures, who's keeping them super tight. This is a good example where this strategy clearly intends to be long momentum and short value. Like something interesting happens right around here, but basically it's allowing itself a budget and it's maxing that budget out. That's fine, but that will show up as additional common risk exposure derived returns because it's persistent, right? So that's different than saying, hey, I have this model that's telling me when to get long or short momentum. I'm just always going to have 10% exposure to momentum. So that's sort of like a persistent bet that's, you can see, well, whatever's happening here with short-term reversal, maybe this is just happening, or maybe it's intentional and it's timing, but it's taking on different exposures, and sometimes it's short-term reversal, and sometimes it's long short-term reversal. So that's kind of interesting. So again, okay, here we're now, that one was, yeah, so this one was long momentum, short value. If I just pick out the two most obvious, so okay, same thing here, right? Now this is the same author, so that makes perfect sense, maybe similar kind of concept. And then, again, you can kind of see like just what are the bounds here. So this strategy is going from, positive 20 to negative 20% exposure across sectors. And that's also kind of interesting sometimes to look at. Oh yeah, I almost forgot to mention one of the things that my colleague David specifically asked me to ask you guys for. So this is good, we're talking about sectors. So here you can see like, okay, there's actually like this fairly persistent layering, like this strategy, and I need to like move this window so I can see, is like persistently long tech and short energy, maybe, it's hard to tell, energy or industrials or something like that. So this is like one thing that I think can be a little bit problematic. Like really, if you're making a persistent bet on a sector, then it can be very tough to disentangle, like, well, is this strategy good because I have a good idea, or have I been lucky that tech has done well over this particular time range? So you ideally like to see, sure, you can take on sector exposures, but ideally they'd be very small, and ideally they would be dynamic and not persistent. Let me skim through to see. I had one example that highlights this like thing around energy that we were just talking about. So I was asking my colleague David, who is helping me cull through all these strategies and combine them together, like, hey, I'm going to be talking on this Tearsheet review webinar. All the strategies look really good. I'm going to not really have all that much feedback to give. What should I be asking people for? And the first thing that he said was actually that what would be really interesting, and I think these would work in the contest, although if they didn't, I would love to hear from you guys, is sector-specific models. So one thing that we have noticed, and here I'm just highlighting Leo's strategy just because it has an example where you can kind of see that it's not a huge amount, but cumulatively it is hurt in the energy sector. It's sort of persistently not profitable in the energy sector. And specifically across our view of the algos that we've been evaluating, that's actually a trend that we don't see a lot of models that tend to do very well in the energy sector. And I think the healthcare sector was another one that's problematic. So one thing that I think would be very interesting is, if folks have specific expertise or interest level that's more granular within sectors, to build a model that specifically just trades stocks in one sector. Now with energy, that can be tricky because you have got a lot of different types of stocks that sort of are within that energy sector, and many of them have their prices fairly tied to underlying commodities. So there definitely takes some thought and some creativity, but if you go and dig into, for example, I think just the Morningstar asset classification data that we have, you can subdivide the energy sector and get down into the industry level. And you can start to look in there and try to develop hypotheses about maybe which energy companies you think will outperform other energy companies. And when you think about a sector model, specifically what we're looking for, and consistent with what we always say we are looking for, is stock selection or stock ranking. So we wouldn't be looking for a model that times the energy sector and says, oh, now is when I want to get really, really long or get really, really short energy. But rather, you'd love to see a model that says, I'm just going to trade energy names, but I'm going to still be market neutral. I'm going to still be dollar neutral. I'm going to still have no exposure really to the energy sector. But I think I can do a good job of sorting what energy companies will outperform others. And so specifically was really interested in energy and in healthcare, but I think any sector-specific models, we would be interested. So I was thinking about, and I'll let Paige and Phoebe run with this idea if they like it, that we could sort of specifically aim our next Tearsheet review webinar around sector models, and maybe specifically solicit you guys if you have ideas that are sector model based to submit those. And I'm willing to do one sooner than next quarter. Maybe we could even say as soon as we have 10 of them or something along those lines. So we'd love to hear feedback from you guys around, that sounds interesting, or you have questions. We could start a thread around that.
So Joaquin said that sector concentration is max 20% for the contest.
Okay, so let us think about that, but you could submit to this contest, which would be submit your Tearsheet with your 100%. Now, sector concentration, max 20%. Okay, yeah, I'm going to go look at that. I think that you're right, but you see what I'm saying, that you would be 100% in a given sector, but you would be long and short. Yeah, we've been thinking internally about whether we start to create sort of specific sub-contests, but actually the thing we had been talking about was that a nice way to prototype that will be to just sort of do something like this, where we have a thread where we say, why don't you submit them? Maybe we can even try to get some type of prize together. Okay, so I think that kind of covers what I wanted to talk about. Let me see if there are one or two more questions. Okay, I think I answered all the questions. Thank you, guys.
Thank you, Jess, as always. That was great. So yeah, if you did submit a question and we missed it for some reason, feel free to post it in the forum thread that we created where you submitted your Tearsheets, and hopefully someone will respond to it and get you an answer. And then I just wanted to mention that Jess is keynoting our QuantCon conference this year in April. It is in Boston, so you can go to quantcon.com to learn more about the speakers and the agenda for the conference. And if you aren't able to join us in person, we are offering a free live stream this year. It's our first time doing a free live stream, so you'll get access to all of the talks presented during the main conference on April 5th, including Jess's. So make sure to register for the live stream if you want to see her presentation.
And I should say, I'm going to make my best effort to follow up with everybody one-on-one. So hopefully you'll get an email or something from me with feedback about your strategy, since I had to keep the Tearsheets, the review, pretty high level.
Great. Thanks everyone for joining.